Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Dave Weisberger, co-founder and CEO of CoinRoutes, which provides algorithmic trading and consolidated market data products for digital assets across multiple exchanges and liquidity providers. He joins us to talk about the wind down of Silvergate. David, it's great to see you as always. Welcome back to Trade Talks.
Thanks, Jill. It's great to be on again. It's been a while.
It's been a few weeks where we're hearing about, Silvergate, Silicon Valley Bank, seems everything with the SI in front of it. But to you, with Silvergate, it's neither surprising nor damaging to the crypto industry or Bitcoin directly.
Well, I mean, it depends how you define damage, right? So at CoinRoutes, we have a lot of data. So this morning, with the closure of Signature and Silvergate's network, I just did a quick study. And what we're seeing is the dispersion between exchanges. The market had gotten very efficient because between Fireblocks and others for moving coins around, and Silvergate and Signature to be able to move dollars around quickly, arbitrageurs were able to keep the prices in line. If you compare the last 24 hours, however, with the 24 hours, the same exact period a week ago, we find that the spread for trading Bitcoin widened from about 1.9 basis points to somewhere over 10 basis points. So a very significant widening of spreads between markets, which really is just a measure of overall inefficiency. I mean, it's not huge, like it's not multiple percent like it was back in the old days, but the fact is markets have gotten less efficient now. And that creates opportunities for some, and it creates costs for others.
Right. But you also think that fractional reserve banks that rely primarily upon crypto exchange dollar deposits is problematic. How so?
Well, I mean, I've said this before. It's not crypto per se that's the issue. It's different deposits have different volatility characteristics. So I'll give a simple example. My company, while we have something to do with crypto, we're a software company. Our bank deposits are very stable. We are borderline profitable, so we don't have a whole lot coming in and coming out. Our expenses are close to matching our income, and so our deposit don't move very much. But now a crypto exchange is something different. If, for example, this morning, if you looked at the dollar balances on any particular crypto exchange, my guess is they are dramatically lower now than they were about 10 hours ago. Why? Because Bitcoin rallied over 10%. And so what does that mean? That meant people who had deposited dollars buy Bitcoin, and the people who are selling are probably raising liquidity and therefore probably transferring their money out. And so the net, if you're a bank on the other side of those transactions, you're going to see the dollar deposits fall probably fairly dramatically. It turns out that crypto deposits are more volatile for that reason. There's not anything wrong with that, but it does mean that the banks themselves need to have better risk management. They need to understand that they shouldn't be taking long duration risks with those assets. So instead of buying 5-year or 10-year bonds, for very stable deposits, they should be buying, overnight or 30-day T-bills. And that way they wouldn't have that big of a mismatch. But unfortunately, at least in the case of Silvergate, they had a very large mismatch. We still haven't figured out what's happened to Signature, so I can't really comment there.
Well, it sounds like it kind of always comes back to this liquidity issue. It's really what it's all about, regardless if it's crypto or another asset class that you're trading. It all comes back to liquidity.
Yeah, it's very much so, which is why the most puzzling thing that's happened over the last few weeks was that Custodia Bank, which was Caitlin Long is associated with. I don't know if you talk with Caitlin, but they had applied for a Fed charter, and their bank has no fractional reserve banking, meaning there could never be a mismatch. And there never could be a risk. And for reasons that are very hard for me to discern, it seems like they said no to that because it was crypto, without actually looking at the underlying risk reward profiles of banks. And that bank in particular is set up to be not fractional reserve. And just to be specific, what do I mean by that? If in a fractional reserve bank, well, if you have $100 billion of deposits, you could literally have $1 trillion balance sheet because you could lever that up. Because you don't expect to keep cash on hand for all $100 billion. Well, if you're non-fractional reserve, then you have $100 billion, you have a $100 billion balance sheet, that's it. You can't go beyond it. And that matters. And it's puzzling to me that the regulators look at it that way. There's other puzzling things that are going on, but what we know is that there are lots of banks, the Federal Reserve included, that have major holes in their balance sheet. right? The major hole from buying long dated bonds when interest rates were under 2%, and they have them now, those are all underwater. Now, they claim if you hold them to maturity, you'll get your money back, and that is true, but that's really a misnomer. The fact is every trader, and I spent most of my years trading, marks to market. You say, okay, what's it worth today? The reality is if the entire banking system had to mark to market their bond portfolios, it would be a huge, huge hole. The hope is that people will keep their money in the banking system and allow the banks to hold to maturity now that the Fed has stepped in and said, okay, we're going to guarantee your deposits. So that's really what's been going on.
Yeah, I mean, it's always been the case in the US with our accounting and the, our accounting systems, which are so complex, and banks are going to bank and do what they can within those guidelines. So do you think that this could impact the regulatory environment, whether it's regional banks or banks that are within the crypto space? Does something have to change?
Well, I mean, the truth is we need better regulations, both of banks and of crypto. This is not a crypto issue. Let's be really clear about this. Other than the fact that some senators have a vendetta against crypto because they don't want to see Bitcoin become an alternative to dollars. They don't want to see DeFi become an alternative to the banking system because that would decrease their power. Other than that, there's not a lot that's going on. The crypto issues that happened last year, there are 2 points to be made. Point number one, FTX was a $8 to $10 billion theft. We'll figure it out, hopefully in October when the trial starts. But the fact is it was a massive theft. And sure, that put some strain on the system, but no more than Madoff's theft did or other thefts did. The other was we had a series of companies do something horrible. And it's something that Gary Gensler and I agree on. They took risks and didn't disclose those risks. And that is really bad. And that's what happened with Celsius. That's what happened with BlockFi, et cetera. But arguably, what caused Silicon Valley Bank to fail was they took risks that were not well disclosed to their depositors. In a shrinking depositor base, because VC funding slowed down, they got exposed for having taken risks in their bond portfolio. But quite frankly, a lot of banks have taken risks that are not disclosed. And that's really the issue here.
All right, Dave, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.